one thing I think that people don't fully understand is how you could still retain consumers who love your brand, but if they are coming with, much lower frequency, that can have such a massive impact on your top line and overall business model. So, if SoulCycle goers, and you could, fill the blank with any brand name, we're going, 3 to 4 times a week for, a lot of their valuable customers. And now they're going 1 time a week. I mean, that matters enormously in a pay-per-class model where you don't have that locked-in membership revenue. And this is a business that needs volume to drive operating leverage and make the unit economics.
Okay, we're live. Welcome to this week's episode of Lifts. I'm Matthew Januszek, and I've been rereading a book again called The 80-20 Principle by a guy called Richard Koch. And I interviewed him many, many years ago. So I'm curious to see whether the book has any relevance to our conversation today. So I'm here with my co-host, Mohammed. Iqbal. Mo, how are you doing this morning?
I'm doing good. I'm back in the home studio. I just got back from a couple days in Minnesota, which was always interesting. I have not been back to Minnesota in a few years, but for a lot of people that might not know, it's the home for some of the largest brands in the industry. So it's the home of Lyft brands.
Escape as well, now.
Escape to Minnesota too? I thought Escape was in Wisconsin.
Well, actually, all right. Yeah, now you're testing my geography. I fly into Minnesota and then I drive for about half an hour to Wisconsin. Yeah, okay. So there you go.
Well, let's just say you're close enough to Minnesota.
A neighbor of some of the brands.
Very much so a neighbor. But you've got Lyft brands, so in Snap Fitness, Lifetime Fitness, which is in Chanhassen, and then Purpose Brands that owns Anytime in Orange Theory. So being able to go to all of them and see all of them in 1 week felt like incredibly productive. It was really good. Before we bring in our guest today, I want to set this one up because I think the timing of what we're about to talk about is honestly too perfect. And it's a little bit personal too. We'll be talking about a few topics, but one of that is going to be around SoulCycle. This week, SoulCycle's CEO, Evelyn Webster, left after almost 6 years. And she's not even staying in fitness. She's moving into a podcast company, of all things, but it's a highly rated podcast, and she has a media background, so it's just a perfect fit for her. But in addition to that, a couple of days, maybe the next day after she stepped down, they also announced the closing of, as far as I know, about 8 studios, even though the number's not really public. It could be high as 10. In fact, today I saw that a studio in the UK, Notting Hill, shut down. And these are studios that I have actually ridden in. And for full disclosure, I think a lot of people who are listeners know that I was an avid SoulCycle rider. In fact, I've logged over 1,000 rides. When I'm even out in the Hamptons or in the city, I used to kind of plan my mornings, sometimes which is kind of odd, around my favorite instructor or around rides. But it was even deeper than that because not only was I a rider, but I also had a very close working relationship with SoulCycle, working with their booking platform, the digital experience, and even the ill-fated Soul at-home bike. And I know we've talked about that a lot on the podcast as well. So when I talk about the brand, I'm not just delivering the news or reading the headlines, but I've actually had an inside view of it. And here's the thing. I think the investors saw it too. Equinox took a majority stake in SoulCycle in around 2015. SoulCycle had plans to potentially go public. There was talk about they were going public, they were not going public, and then they were going public again. They got pulled out, but the IPO never happened. Equinox ended up buying the founders outright around 2016. And I think for the founders, they walked away with an incredible outcome. And the brand they left behind had around 100 studios. I think 99 was the most that they've ever had. Today, they sit around 57. And while that allure of SoulCycle is gone, I really think that it helped define boutique fitness. In a lot of ways, it created the category. A lot of the things that SoulCycle did, we see today in boutique brands. I could see, remnants of it coming through and seeping through almost any boutique experience I go through. They defined the category. They were the trailblazers. And I think that, to me, the impact of SoulCycle is so much greater than the brand. And we can talk a bit more to that. In addition to that, over the last 12 months, we'll be talking about certain movements that happen in fitness. We'll be touching on brands like EOS Fitness, brands like Crunch Fitness, even 24-Hour Fitness, which recently was reacquired by our mutual friend Mark Mastrov. So how does this all happen? How does a brand that had such big cultural significance go on a decline? How do newer HVLP brands that really weren't the darlings 15, 20 years ago now seeing all the investment money coming in? So there's some really interesting topics here. Look, I've been building in this industry since 2012. I was inside a lot of these brands. But today, I want to flip that lens with our guest today. We're going to be looking at it from the investor side. We spend a lot of time on this show talking to founders, operators, and innovators. But today, we're going to be looking at it from the eyes of someone who's been in the room with some of the most significant transactions the industry has seen. Our guest today is a good friend, Aarti Kapoor, who is now the managing director of at Cascadia Capital, where she leads the firm's multi-unit consumer services practice with fitness and wellness right at the core of it. She spent nearly a decade earlier in the industry, where she launched the first health and wellness-focused investment banking practice on Wall Street with Moelis and Company. I might not be saying that right, so Aarti, you could correct me on that. And that's where she did some of her earliest work and some landmark deals, including the sale of Flywheel, SoulCycle's biggest rival at the time, and the sale of Barry's Bootcamp. From there, she moved on to Goldman Sachs, where she worked on some larger deals and scale transactions, including the Exponential Fitness IPO and the F45 Trading IPO, plus some early work with Lifetime Fitness as well before it returned to the public markets. She then crossed over to the investment side, spending 4 years at VMG, doing growth equity and backing middle market consumer companies where health and wellness were at the front and center. So she's seen both ends of it. She is now back on the banking side, and we are excited to have her on. Aarti, we've been talking about this for a while now. I'm really excited to have you to list. But before we dig in, I'm curious, you are an avid fitness enthusiast, and you are also working in the category as well on the banking side. How did you work on that niche? Did you have to go and push to say, look, I really want to focus on fitness and wellness because it's a passion of mine? Or did it just come to you naturally?
Yeah, all great questions and great commentary. I'm super excited for today's conversation. So thank you for having me here. It was back in 2012 when I saw my habits changing as a consumer, and my foray into covering fitness professionally really just happened very organically. I, like many others, had a gym membership, decided to try out this thing called group fitness that didn't even have a label, a boutique fitness at the time. Became completely addicted, saw my spending habits change, and kind of used that as a proxy for, hey, maybe something is happening that is broader than just me, and maybe this could be a business opportunity. I coincidentally lived on 21st Street between 5th and 6th, next to the first Flywheel studio. So I remember falling out of my chair, seeing what they were charging for class, because it was a lot more than I could afford at the time, and decided to try it out anyway, and then ended up completely reshuffling my spending habits. And I'd go back into the studio again and again. And it's ironic because I'm still an avid SoulCycler now, and I know they're direct competitors, but I'd go back and see the same folks showing up. And I kind of had an aha moment, one of those light bulb moments in the studio one day where I looked around, saw every bike full, and did the math in my head in the middle of a class about what unit economics must look like, and ran into work that day, told everyone we need to cover Flywheel and Berries and this group fitness phenomenon. This is going to be the future of fitness. And I was frankly, politely told that I was a little crazy and people had no idea what I was talking about, and it wasn't a big enough industry, and I should just sit tight and do my day job. I luckily had one person who, was ready to think ahead and had an open mind. My mentor, it is now one of my best friends in the world, Roger Hoyt. He said, okay, let's go see what you could do. Don't drop the ball on your core job, but let's see what's out there. And he supported me in exploring the opportunities. And then working with Jay and Ruth and, the team at Flywheel, that was my first M&A deal in this space. And it was amazing when I actually started to knock on doors and say, hey, guys, I see what you're doing. I think there's a huge growth opportunity here, but it's a capital intensive business. You need money to grow your business, let's talk. How many people wanted to talk? And so, one door opened another, and being an early mover is definitely helpful. So, built a nice business that I, still very passionate about today.
Mo's explained or given a nice explanation of some of the things that significantly change in the business. And as we've continued with this podcast, there's been quite a few surprises really that come over time. And as an investor or someone that is responsible for making relatively large bets on business, as I get to understand it, there's a lot of changes. There's market conditions as the brand expands. There's things like locations. There's founders. There's relationships that the founders have with other people or key people in the team, both within their business and also on the investor side. So with all of that variability and making decisions, not just for today, but things that are likely to be multi-year decisions and bets, what would you say are, let's say, the top three things that give you genuine confidence to back a business? And has that changed over, let's say, the last decade, where the world seems to be a lot more unstable than probably what it has been earlier in my business career?
Yeah, it's a great question. It's a big question. It's one that we're talking to founders and operators and shareholders about on a regular basis. I'd say, if I were to distill it down to three main buckets, I would say, investors are underwriting to three things simultaneously. It's brand equity, it's unit economics, and then it's growth runway. And, a business needs to demonstrate strength across all of those to be institutionally transactable. I think on brand, this may appear qualitative, but there are plenty of ways to actually measure it. Folks look at consumer loyalty, net promoter score, repeat visit rate, retention curves. Those are the key proxies. And investors obviously want to see a brand that has staying power. Longevity with consumers is differentiated in what has become a very crowded landscape. And so there are a number of different ways to quantify the strength of a brand. The second piece is probably the biggest bucket, because there are a lot of great brands out there, but it really comes down to unit economics. AUV, which is average unit volume, that matters up to a point. You need to ensure that there are enough dollars to work with to make a business work. But at the end of the day, it's your four-wall margin, your cash-on-cash return, and your payback period, which is essentially all a proxy for, does it make sense to invest in building out new units? And people want to see that, that story, economic story is portable and it's replicable. And that, the portability is really one of the most scrutinized attributes, because think about how many concepts have worked well in a home market. But there's that big question of, if I test this elsewhere, is it going to work? And many investors don't want to make that until they've seen the data points to support that it works in at least 2 or 3 markets. And there's consistency. And then, extra bonus points if you can prove out urban and suburban, because that just really, broadens what your total addressable market could look like. And then, growth, ultimately everyone's in it for growth, right? That's how you make your money. So, in the same store sales trajectory, you want to make sure that your existing units can continue to grow long-term and you have, levers that you can pull. But then obviously a lot of it is about new unit expansion, especially when you invest at the growth stage. And so, that's why unit economics and the portability matter, to say, can I keep building this out? A lot of the businesses that have transacted recently in the gym category have checked the box on this, but revenue composition is important, and recurring revenue and having that line of sight, membership and visibility into what's coming in every month or year. That's another big piece. So I would say, it comes down to brand, economics, and growth. If I really had to bucket it in 3 things, of course, the list is extremely long when you go into an investment committee meeting. But those are the main, tenets that folks are looking at. And then, you asked, have things changed? I mean, absolutely. The environment when I started covering this business, it was well before COVID. I mean, 2012, 13, 14, I think the Flywheel deal was in 14 and Barry's in 15, the first time they took capital. Boutique fitness obviously had a very different relationship, consumers had with, group fitness, and because it was on the up and up. And so early in the curve, people were willing to pay a lot more for a lot of those assets. I think execution in terms of growth ended up becoming a little more complex than some anticipated. And then the big thing was obviously COVID reset the environment in many ways, and obviously gave consumers a chance to revisit their habits and diversify how they spent their time and their money. And it made everyone a little bit more cautious about potential disruptions to consumer behaviors and stickiness. And so I'd say, scale matters more than it did before COVID. I think pre-COVID investors would take a swing on a high quality boutique fitness concept with fewer proof points. I think membership recovery curves have become a lot more of a central diligence focus. Today, investors want to see membership that is not just recovered to pre-COVID levels, but grown well beyond it now. A little bit more diligence on real estate and lease liabilities and AUX. And then, of course, and we'll talk about this when we chat more about SoulCycle, but just getting ahead of how consumer behaviors may change, and making sure that there's confidence in longevity and that flexibility over time as consumers evolve, both in terms of their preferences and needs.
Yeah, Archie, I didn't know that early story with you in 2012 and how you had to take the class and then go make the case with your manager. It was very similar to me. I founded SmartWorks in 2012, and I literally had to go to Mountain to find Joe DeSena on Spartan Race to pitch my idea. I had to go find Harvey at a cocktail hour and talk about what I could do at Equinox. And I literally rode in the West Village to see Julie and Elizabeth at SoulCycle. So, and that's kind of, I think, from an entrepreneur perspective, and you certainly are as well, but you really have to go meet the decision makers where they are, and you don't stop and you don't take no, and it's never easy. But I did not know that about you, and it's interesting. We should chat more about that offline, but we were doing some of the same things at the same time. I'd love to compare notes. There's a lot that you talked about, and we've covered a lot of these things individually from and I think operation standpoint, things like being smart about how and where you lease and long-term lease agreements, things like recovery of the membership and of the consumer. What does that recovery curve look like? The fact that the consumer has changed post-pandemic in a lot of ways. Their behavior, we knew was trending in that direction, but was really pulled forward, and that evolution accelerated. We talked about the change in boutique, and I want to let's go to SoulCycle now. Obviously, SoulCycle, as we talked about in the beginning, defined the category in a lot of ways, created the category as well. It was iconic. I would run on the West Side Highway and see SoulCycle shirts for almost a decade, right? A lot of people were out there doing that. They created apparel as a component in fitness, where I think before SoulCycle, it really wasn't a big driver, but here you are, SoulCycle really being iconic and creating that brand. How much has boutique fitness changed since SoulCycle? And then maybe speak a bit about the mid-market and HVLP and how they've influenced the entire industry as well.
So lots to unpack there. And I think, just starting off with SoulCycle, this one is also deeply personal to me. I've been a rider for almost 15 years. I still go every Saturday. I think anyone who knows me or has spent more than 3 minutes with me knows about my undying love for Anthony Winters and his, Taylor Swift classes on the Upper East Side. There's still incredible pockets of community, and I still have a ton of respect for the brand. And when I think about this topic, I really look at it holistically as a professional and as a consumer. While SoulCycle has obviously hit some bumps in the road, I don't think it's at all a proxy for boutique fitness no longer having a place in the overall fitness landscape. I think, in this case in particular, it was just a perfect storm of compounding factors. We've talked many times about the, cultural shifts away from all cardio sweat culture, the consumer education around functional training and reformer workouts and strength. And, as I'm a Form 50 loyalist, and, how challenging and effective that workout is now firsthand. But we also talked about COVID and how, COVID really reset habits. And one thing I think that people don't fully understand is you could still retain consumers who love your brand, but if they are coming with, much lower frequency, that can have such a massive impact on your top line and overall business model. So, if SoulCycle goers, and you could, fill the blank with any brand name, we're going, 3 to 4 times a week for, a lot of their valuable customers. And now they're going 1 time a week. I mean, that matters enormously in a pay-per-class model where you don't have that locked-in membership revenue. And this is a business that needs volume to drive operating leverage and make the unit economics work. So I do think, in SoulCycle's case, it's a perfect storm of, cultural shifts, COVID resetting habits. And then, this one's discussed a little bit less, but passage of time, the riders who make SoulCycle what it was at its peak are nearly a decade older now. And so their bodies and priorities and their workout needs have evolved. And that's not a criticism. It's just reality. It's, fact. So do I believe in the importance of the brand? Absolutely. I'm still a huge fan. The longevity of indoor cycling, yes, there will always be a place for it. Boutique fitness overall, of course. It's just that consumer behaviors and preferences are cyclical. And, SoulCycle is in a tough part of that cycle right now. Oh gosh, that one was not intended, but certainly fits. So yeah, look, with SoulCycle, I think it was a perfect storm of those compounding factors, but I don't believe it's a proxy for boutique fitness not having a major future in this industry. I still believe in the Soul brand, longevity of indoor cycling, and most importantly, continued demand for group fitness, the communities that come with group fitness. It's just that consumer behaviors are cyclical and preferences change over time. We've seen so many different waves throughout so many consumer different industries, and Soul is just in a tough part of that cycle right now. Mo, you mentioned HVLP and the importance of HVLP and just all the, mind share, dollars, attention that's been flowing in that direction. HVLP is, unambiguously the most active segment for institutional capital right now. You've seen recent deal activity that's been pretty high profile. Obviously, Leonard Green and Crunch, TSG and EOS, Princeton and Amp Fitness, obviously a smaller deal, but fairly recent earlier this year. And the structural reasons are, it's the largest TAM in all of fitness, total addressable market. We all know the stats around, only 25% of American adults having gym memberships. So there's just so many consumers that are available for conversion. People love the macro resilience, whether it's $10 a month, $20 a month, even 30. Obviously, there have been multiple waves within HVLP, which we can talk about. Those price points still can hold through a downturn. There's been a lot of talk about the K-shaped economy and, the impact on consumers with less discretionary income. And obviously it's a pyramid. And so investors want to make sure there's not, too much macro exposure. And then unit economics, of course, are great. And we talked about the importance of that. It's the crux of any business model. And I believe, obviously, Planet has done incredibly well, despite some pauses in that trajectory. And Crunch has done incredibly well, but there's still room for more. And there's still a lot of optimization that can also happen within those systems. And you've seen a lot of active deal flow at that franchisee level. So HVLP is very attractive, size of market, long-term prospects. But I still think there's room for deals in boutique. And then we've obviously seen in the public markets how well Lifetime has done at that super premium price point for health clubs as well. And, mid-tier, I know for many years now, mid-tier's been structurally challenged, losing share to players that have been specializing in kind of both ends of the barbell. But, I'll take a little bit of a contrarian view here and say that, I think the lines are starting to blur. We had HVLP 1.0, then 2.0, then 3.0. And now these value players continue to add amenities and programming, and they're increasing their pricing and offering new premium tiers as a result. And with enough of that, then you're not too far off from that mid-tier pricing model. So, there may be opportunity there as well. And we've seen some deals get done in what's bucketed as a traditional mid-tier, with 26 North and One Life and Garden State and Garnet Station and Mountainside. I think undifferentiated metal, like concepts that are not cheap enough to win on price and not premium enough to win on experience. I still think those will be highly challenged, but there have been some operators who've cracked the code and been able to find the right balance there. And I'd say, One Life and Mountainside fall into this latter bucket. And, that's why they were able to garner great institutional capital.
Getting investment from some of the big names like yourself clearly is going to have some impact on the brand names that the consumers and the industry people get to recognize. You've mentioned a couple there in the HVLP and in the boutique market, and depending on the moment in time you study them, they, again, as an outsider without seeing the numbers like you do, you can see some of these as success stories or some of them as potential failures. If we look at the investment community, which is the world you're in, I did a bit of just research on Google, and it says somewhere between 20 and 30% of private equity investments don't deliver the returns that they were expected, and some portfolios that climbs even higher. So what actually separates the investors and the firms that consistently back the right businesses compared to those who seem to miss? Or is there really not a huge difference? It's just the relationships that they have in identifying some of these opportunities and being able to sort of get ahead of the pack. I'm just curious because it's a world that I don't know anything about, and I'm just wondering, what you would say really sort of separates the winners from the losers in the investment world.
This episode is brought to you by our partners at eGym. eGym believes the future of health starts on the gym floor, with strength training at the center. That's why they're building an ecosystem of connected equipment, AI-driven software, and wellness solutions to empower operators and improve lives. Their mission? To transform healthcare from repair to prevention and make fitness accessible, personalized, and measurable for exercisers of all shapes and sizes. See how this all fits together at egym.com.
Yeah, look, there are a lot of smart people and a lot of great firms on Wall Street covering consumer retail brands, but I will say every single investment firm has had stories and portfolio companies that have not worked and that have not gone according to plan. I think experience is tremendously helpful. Folks who have done work with specific business models, whether it's, hey, we've done corporate-owned multi-unit investments before, so we know how to look at corporate-owned models, and we know the pitfalls, and we know what to look out for and what are the red flags. Or we've done a lot with franchisor models, and we know, what are the red flags there and what should we get ahead of. And so I do think there's a lot about pattern recognition. And so a lot of times what you'll see is the first time an institutional investment firm is getting into a category, they usually make a smaller bet because they know they have a lot to learn about that business model or that category. And once they've kind of gotten the learnings from that, then they're willing to make a much bigger bet in the same business model because they have learned along the way, and there's that pattern recognition that really drives success for future investments. So I do think pattern recognition and just that comes from experience is really important. But of course, everyone kind of has a similar investment committee, tear sheet looking at all the things that we talked about, the brand KPIs, the unit economic KPIs, the growth prospects. I do think another differentiator is how hands-on are investors, right? So there's just such a wide range of models. Some will make a ton of bets, and when they have that big of a portfolio, they can't be as hands-on with their investments. Versus when they have fewer, they can really roll up their sleeves and keep tabs. Not just the quarterly board meeting, but what happened this month? What happened this week? And that really lowers the chance of things going, off the rails significantly. So it's experience, it's investment style, and of course, there's a big luck factor as well. There are a lot of people who just got lucky with their timing and love to take credit after the fact of having all the foresight. But there are a lot of things that have happened in this world that we've seen that no one could have predicted. And I think there's of course a luck factor in it as well. But what you'll see is there are a lot of smart people out there, and those IC checklists can look very similar. So then it just comes down to individual experience, and that pattern recognition, I think, is one of the biggest value adds.
And just a quick jump on that question then. So if someone's looking on the, if you are an operator, like, is there one thing then based on what you've said, for me, what I've just heard is having someone that's a little bit more hands-on is probably going to be a little bit more useful than not. Like, is there one thing that someone should look when they're searching out for someone to invest in their business that that really would help them navigate a difficult road ahead, which is pretty much what most businesses are dealing with today?
Yeah, I mean, I would say there are probably a couple things, but I'll keep my list short. So, direct experience with relevant business models. It doesn't necessarily need to be the same industry, but the business model. So, you know, corporate owned, you could have owned a med spa and have experience that's relevant for a fitness business and vice versa. Um, Franchise, you could have a restaurant franchise and that could be relevant to owning a fitness franchise, but it's relevant experience with a business model, I think is a big thing. I think, chatting with other portfolio company management teams about the investor's style and value add and treatment of a management team is important. That is one thing that really differentiates one firm from another. It's how does this investor do when things are not going so well? Are they, barking at you, asking why numbers aren't what they should be, or are they rolling up their sleeves saying, okay, how do we fix this? How do we help? And I think just the management relationship and level of being, hands-on and willing to dive in is very differentiating. So those would be kind of my two big things to look out for.
Look, I think timing, to your point, and luck matters. So just a couple examples that come to mind in our conversation: North Castle Capital and Barry's Bootcamp, and VMG and SolidCore. I would say that at the time, including unit economics, they were somewhat similar at the time those investments came in. Obviously, SolidCore absolutely went on a tear for many years, riding the Pilates wave. When you're making an investment, or if you're looking to do an M&A acquisition, how important is trends? How important is the consumer, the strength of the modality, if it could be resilient through changes? How do you capture that when you're pricing in the value of a brand?
Yeah, I mean, look, no one's perfect at predicting consumer trends. Otherwise, we'd all be, trillionaires here. But I think there are definitely indications that you can look at that help de-risk an investment. So, there are a lot of concepts you may remember just in the peak of boutique fitness that were just incredibly challenging, so challenging that most people probably couldn't do them. And they took pride in how difficult they were. And, oh, so and so nearly passed out after class because it was such a hard workout. Like, that's not helpful for attracting investment, because people just saw that as you have a really narrow TAM and your LTV for your customers is going to be short. The reason that people had been really enthusiastic about indoor cycling was a lot of people can do it. Almost anyone who can be active can do cycling in some way, shape, or form. And there's a potential for very high LTV because this is something you can do over the course of your lifetime for many, many years. So that was something, that I think investors like, just the longevity, what it meant for customer LTV, the TAM piece. And on the flip side, some of those tougher concepts, had challenging questions about that. And, I remember when we were working on the berries sale when I was back at Moelis in, 2013, 14, folks asked the question of, how scalable is this? How many people can actually do this workout? And berries had actually been going through a very proactive process and effort to make their brand more accessible. And you may remember the previous brand aesthetic, which was, the dog tags and, a very different behavior for instructors. And then instructors were told and trained to read the room, and that, a 10 a.m. class in, XYZ market might be different from a 6 a.m. class in New York, where you just have a very different consumer. And so you need to modify, what things look like in that class so that you can be more accessible. So I do think that accessibility, the longevity piece, very important. But look, no one can predict, trends perfectly. And I do believe, things can be very cyclical. We've seen consumers in so many industries, swing to one end of the, pendulum and then go all the way back. And so there's some that you just can't predict for. But TAM is the biggest thing. And then earlier, I just talked about retention curves and stickiness of the customer. And obviously, that's just a great way to see for this concept, are people coming back?
Yeah, I want to touch on one more thing here. So obviously, understanding the TAM, understanding the consumer. Right now, there's a shift away from hit. Really, is what that is. Away from a bearish, away from a soul cycle, more into wellness, longevity, low impact, and we're seeing that play out. And it's a big reason why Pilates is having a moment. How do you differentiate? And we get asked this question a lot. In fact, you and I, when we attend conferences, brands come up to us and say, I'm thinking about franchising or I'm corporate owned. And how do you maybe speak to our audience a little bit about how you price an entirely corporate owned asset like a Solid Core, maybe versus a franchised based asset like a Strong Pilates? They both have the similar amount of studios, but speak a bit about that.
Yeah. So I'd say in terms of investor checklists and how people evaluate businesses, those same buckets I talked about still do apply, but there's an incremental list that folks look at for franchisor models. For corporate owned businesses, investors are basically just underwriting the operating model. It's the four wall margins, the labor efficiency, the lease structure, corporate overhead, scalability, and the investor owns the P&L, so that's every cost line matters. For franchisors, the value creation shifts a little bit more to system level scalability. And investors are not just underwriting the brand, they're underwriting the franchisee base and the ability to grow that franchisee base and build a development pipeline and the quality of the royalty stream. And so there are a bunch of franchisor specific items that don't apply to corporate models. It's franchisee unit economics, what percentage of franchisees are profitable, signed versus speculative pipeline, franchisee health and satisfaction scores, et cetera. So there are, some other metrics that are evaluated. At a whole, just taking a step back and, stepping back from KPIs, franchisors tend to be valued at a premium versus corporate owned models because of that asset light nature of growth, what that means for potential rate of growth. There is a bit of a de-risking that comes for the franchisor by essentially outsourcing, some of the growth or most of the growth. And the margins can be much higher just given, the business model and what that means for corporate level EBITDA margins. So we've seen there have been some crazy blockbuster deals in the franchisor world that have, been well north of 20 times EBITDA. There's some that have been wild just because of the growth curve, and a normalized multiple makes it sort of make sense, but it'll be 30 or 40 times EBITDA. There are some wild multiples out there, but I'd say, a really good concept, if you get 20 times, that's an amazing outcome. For corporate owned, because it is more capital intensive and that may change the pace of growth and the risk profile is a bit different. Hitting double digits for an EBITDA multiple is a good outcome today. Now that's evolved significantly from 10 years ago when boutique fitness concepts were getting 20 times also. But, I'd say generally it's a very different valuation paradigm because of the business model. And that's why you see a lot of folks say, I'm going to start corporate owned. I'm going to see if this works. And, maybe I should now switch to franchising so I can benefit from some multiple arbitrage. Now, what folks underestimate is how much time and effort and investment in, the system is required to support franchising. You need the appropriate team, you need the documentation, you need to know how to manage franchisees, recruit them. You need boots on the ground to help them get things going and oversee their operations. So there's a lot of investment that needs to happen before you get that multiple arbitrage, but it is a big reason that you have seen some pivots from corporate owned to franchise. Assuming you're kind of 80% plus franchise, you will benefit from that franchise multiple, which is, significant premium.
I'd like to look through the lens of the founders now, and if you looked at the calendars for some of the top founders and CEOs that built some of the more successful business that you were involved with, and if we sort of use my book, my 80-20 principle, which I'd recommend you checking out in terms of the things that make a difference, the 20% that makes the 80% of the difference, what would you say are some of the sort of vital few activities that the majority of the successful businesses do that contribute to their success for many of the relationships that you've had and been involved with?
Yeah. So I'd say first would just be clean financials and collection of data. For any founder operator, you've got to get your unit level reporting right. And now, not 3 months or 6 months before a process. Investors want to be able to compare AUV, four-wall EBITDA, membership count, same-store sales growth by location over time, and have all be comparable data. And you can't tell a great story if you don't have apples to apples data to support it. So I would say clean books and collection of data would be a big thing. From an operational standpoint, we talked about the importance of portability. There is generally a pretty big discount in valuation applied to concepts that have only one market or maybe two markets, and it's a very specific type of setting versus those that have proven out urban and suburban, multiple different states that don't benefit from brand awareness in one state, for another. So I'd say that geographic portability is a huge valuation unlock. And so if there are folks wondering, should I work on more infill in my current markets or go to a high conviction new market that I know I can execute well, go to a high conviction new market that you can execute well. I think managing key man risk is also an important thing. So key man risk applies both in terms of, management team. You need a management bench so that all the future success is not predicated on one person doing their job. And there's that diversification of risk, and there's a team to support growth because you need more people as you grow. But there's also key man risk when it comes to fitness businesses and the instructor side. And that's something that a lot of boutique fitness concepts had to learn about the hard way, back during the boutique boom. And then ultimately during COVID, when, they couldn't get a lot of their instructors back because they found other things to do. You don't want too much attachment to a celebrity instructor who, is grabbing an outsized share of revenue for you. It's great while you have them, and then if they leave, you're in a really tough spot. And so that's why you sometimes see folks being very thoughtful about how they manage their scheduling and making sure that if someone's coming at 12 p.m. every day, it's a different instructor at 12 p.m. every day, because that way they're exposed to the broader system and not just, one person to get too attached to that they may follow elsewhere. So look, it's a long list, but I would say numbers, geographic portability, management team bench, and making sure to manage, key man risk throughout the system just to de-risk your unit economic profile.
No, I think that's phenomenal advice and feedback. And look, I think in that key man, the instructor being superstars, you could say that about SoulCycle. That really impacted them too. People like Atkins, Sid Miller, we could go on, but they all went on to create their own successful brands. And we talked about this, I think, when we had lunch a couple of weeks ago. I think a lot of brands are attuned to that. The key man risk thing is something actually hits home to me when I think about Sweatworks. And I know when I've had kind of M&A talks earlier,
you're the key man risk.
What did you say, Matthew?
You're the key man risk.
I am the key man. I literally am the key man risk.
Sorry, Mo, called you out.
You did talk to me, but part of the reason for me taking this role at ABC is to allow for that, because sometimes the key man or the key person is the problem and cannot get out of their own way. So I had to actually step out, hire a management team, and then guess what? The business actually grew without me, but because of the processes that I'd put in place for the last 10 years. That's a big deal. And guess what? Now, all of a sudden, people are coming out and saying, have you thought about an exit? I think the other thing I would add to what you said is, and both Matthew and I can relate to this, so few founders, Aarti, think about the outcome when they're setting up the foundation of their business and when they're scaling the business, because they're so in the day-to-day just growth that I think that one of the lessons that I've learned is when you start a business, think about the outcome, and then you build towards that outcome. And a lot of people don't do that. But look, we are almost at time. This has been a fantastic episode. I think we need to have you back again, hopefully soon. So thank you so much for coming. But one of the things that we like to do on Lifts is wrap up with a key takeaway, which is going to be hard because I think there's so many good takeaways here. But Matthew, I'd love to start with you. What is your key takeaway from this episode?
Yeah, well, I was just making a note. Actually, I think we should do a report on if this should be in our briefing as to what to do if you're looking for investment in your business, because I think it was extremely valuable for any type of business that you have. But I'm going to sort of slightly switch the question a touch, because I wanted to find this out to Aarti, and that's like. In terms of a takeaway, do you get blindsided when backing a founder? And has there been any sort of patterns that you've learned to look through, like with individuals, like you are backing people? Like what's a quick example of where you've completely been blindsided, and what do you now do differently when you're assessing some of those sort of key opportunities, or particularly key people?
Yeah, so I spent the last 4 years on the investing side, and now I'm back to advising businesses. But at VMG on the investing side, of course, there were founders who were incredible to work with, and everything went according to plan. And then there are others where we had some very challenging surprises. I think managing your protections contractually is a big way to get ahead of that. So in addition to all the obvious things which we revved up after having those challenging examples of we did extra reference checks. We did it from all angles. We really went much deeper in terms of our, pre-transaction founder checks. We also built in a lot, transactionally. And I think all of the institutional investment firms, especially those who do minority deals, have to build that in. So it's just a lot of rights that you get, where I can get information on this, regular of a basis, upon request. And I get to approve, X, Y, and Z before it gets done. And, there are a lot of things that you would think would be reasonable. And so they were left, unspoken, or there's a higher threshold for approvals. But after folks get burned, they'll tighten that up a little bit. And that way you're contractually protected, because, during any kind of, selling process of, hey, you should give me money, everyone's going to put their best foot forward, right? And they're going to give you the references that'll say the best things about them. But if you really do much broader channel checks and make sure when you're drafting documents, always think about downside scenarios when things get really hard, and build that in contractually, then that, doesn't remove the challenges, but at least mitigates them.
Mo, what are your takeaways from today?
I think my key takeaway is that sometimes the trends are not the thing you should be looking for. There are underlying facts about a business that are important, that might even be more important than a trend. And as I think about boutique, this theme keeps on coming back to me, is resiliency in the boutique business. And can that business adapt to trends? So we saw the transformation of HIT. That happened. We've now seen a shift to longevity. As I'm thinking about some of these new boutique brands coming out, could they withstand another consumer shift? Because, and maybe it doesn't matter. Some investment cycles are anywhere from 3 to 7 years, and maybe as long as you hit that window, it's okay. So maybe it's an issue for the next buyer after that. But I'm just thinking about, as the consumer is shifting, I do think consumer shifts are going to happen now in much faster cycles. Instead of it being 10 to 15 years, I think we're going to see shifts happen between 5 to 10 years. So how do founders, how do entrepreneurs, how do brands manage that shift is something that I'll be thinking about. Well, I was going to ask Aarti, any key takeaways for you from this episode, or any last thought to leave our audience with?
Yeah. So I'd say, at a high level, investors are underwriting those 3 key buckets of brand equity, unit economics, and growth opportunity. There are a lot of underlying data points that they're going to look at to support conviction around those categories. So the importance of having clean numbers, collecting data that can be comparable apples to apples, it's really, really important. Investors are also not just investing in a business, they're investing in a team. So make sure you've built that great team around you. If you're a CEO or a founder, ultimately, if you want to scale a business, you're going to need to have multiple folks around you who you trust, who can scale that business with you. Be prepared for a transaction well in advance of a transaction. And Cascade is always happy to chat about this stuff, but there are a lot of prep steps, and Mo, you referred to them, whether it's structure of a company, or how you've set things up for the long term. There's a lot of prep required, so we're always happy to be helpful with that. And then, yes, trends come and go, and we can't predict them perfectly, but what you can do is de-risk a business model, and that is just looking at business fundamentals and consumer behaviors of that business and stickiness and willingness to engage long term. And there are a lot of things you can't control for, but there are many things that you can control for, and there's data to support those. So I'd say, think about those aspects when looking at potential for long-term success in a business. But this was awesome. So thank you so much for having me. I feel like I could talk about all of this stuff for hours. So also thank you for cutting me off here, but look forward to part 2 down the road.
Yeah, thank you, Aarti. And thank you very much for listening to this week's episode. If you have enjoyed anything that we've discussed here or learned anything, then you can really help us out by doing a quick share. It takes a few seconds. Share it with 1 or 2 people that you feel will get value from this. If you happen to be on YouTube, then leave us a comment. That will help get this spread it out to more people. And if you're on iTunes, then and you could put a few minutes into leaving us a review, that will help us get more fantastic guests like Aarti. So thank you very much for listening, and I hope you enjoyed this week's episode of Lifts.